if you're any emerging market country and you just saw the United States for 10 years hitting a lot of different countries over the head with sanctions, Trump is hitting everybody over the head with tariffs, and you own treasuries and you're really long treasuries, these big central banks are just diversifying their way away from treasuries.
Welcome back to the second part of my interview with Larry McDonald. And stick around until the end. We're going to have commentary out of Jonathan Wellum about his views on what Larry had to say. Okay, so you're bullish on oil, bullish on nat gas. What about gold? You touched on it earlier.
Yeah, I'd rather be long the gold miners like Barrick here. Gold is a lot of central banks are being forced to buy gold up here. Silver, I think the silver miners are really cheap. The SIL ETF, the SILJ. So you want to start looking at platinum, palladium, and things that are in the hard asset community, but not as overcrowded as gold. Remember, gold's a $16 trillion market cap. So if you're a big central bank globally and you see the White House sanctioning and tariffs and all this hostility, and you want to diversify your way out of dollars, there's many other solutions, right, to being in dollars, and so that's going to give you a whole different portfolio construction.
So when you say that central banks are being forced to buy gold, it's because of the policies coming out of Washington?
Yes, I mean the last 3-4 years, I mean the Trump team is much more hostile in terms of tariffs and just hostile in general. The Biden team was hostile in the sense that we confiscated Russian assets. I mean, if you're any kind of, and you can say whatever you want about Russia, but if you're any emerging market country and you just saw the United States for 10 years hitting a lot of different countries over the head with sanctions, Trump is hitting everybody over the head with tariffs, and you own treasuries and you're really long treasuries, these big central banks are just diversifying their way away from treasuries.
And you are recommending gold miners or producers because they're trading at such a deep discount to the actual physical.
Yes, and even if you look at just Barrick or Newmont, or just priced Agnico, their true price to cash flow, their enterprise value to EBITDA, they're still in the very low percentages historically, very rare area, and they've all delevered their balance sheets. I mean, and then on the oil side, Weatherford's trading right now at a 3.8 billion valuation, right? Their free cash flow yield on Weatherford, which is a oil services company, free cash flow yield of 550 million on a 3.8 billion dollar market cap. They're buying back like 15% of the public equity. I mean, when you get those types of free cash flow yields with a company buying back stock, it's tremendous value, and there's a lot of great value names in the gold miner sector.
Yeah, they are dirt cheap. It's a sector I follow closely, but I'm just kind of wondering though, is 2 points. First of all, you made mention of the fact that the central banks continue to buy gold because they're forced to, because of they're trying to position themselves against their U.S. holdings. And I understand that, but at the same time, the stocks really aren't moving. There's a few names that are moving. Agnico's done very well, for example. Barrick and Newmont are I would say, suffering because they haven't employed the same strategies that Agnico has. But maybe the gold stocks are pricing in the real price of gold, which is significantly lower. And the price of gold is where it's at now. Let's just say $3,100 an ounce because it's being taken higher by the central banks.
Well, there's some truth to what you're saying in terms of sentiment, but what I think the bigger picture is when you've gone through a 2-year period, maybe of a strong dollar with rate hikes and then tariffs driving the dollar up late last year, that creates a bear market in commodities. That strong dollar, if the dollar is really strong, you don't need to own commodities. And so when you're in a bear market in commodities, the hot money isn't there yet. The tourists are not getting off, or have not been getting off the bus yet. They're just starting to now. And so what happens is people this happens in every great bull market. At the beginning of the energy bull market in 2020, people were long oil, and then they got long Exxon and Chevron, and then they got long the more tertiary, smaller companies. It's the same thing here. The first mover is the mothership of gold, and then you'll see the big cap stocks move, and then the juniors. And that's just the way the sentiment works.
And you mentioned silver. And I know a lot of people are very disappointed in the move of silver so far. Everybody keeps talking about the all-time high of $50, which was set back in 2011. But if you look at it from a nominal point of view, that the real dollar value of silver should be, I don't know, maybe $75. I'm throwing that number out there, but it's been a massive disappointment. What are your thoughts on silver?
Yeah, so silver now is, I think just now, the probability, like we're starting to see the silver miners start to outperform silver. We're starting to see the gold silver ratio still around 90, but it's close to, last 3 or 4 weeks, close to breaking out. And so as the Fed is now in a slower growth economy, and you potentially have a more dovish Fed next year with Trump, right? Because Trump's going to have more control over the Fed. When you go into that environment, at some point, silver starts to outperform gold and the silver miners start to outperform. And now you have the solar upside, you've got the robotics upside. And so you've got all these long-term secular bullish things for silver, whether it be the macro element, the politics, or whether it be robotics, or whether it be, all kinds of solar innovations. So I love the silver names here. You get downside, I think, of 15, 20%, but with some of the silver miners, you get 3 to 10 baggers.
And why do you think Trump's going to have more control of the Fed?
Well, Powell's term is up in the early first quarter next year. And as everybody knows, Trump is not a big Powell fan. He hasn't, he's actually been a little bit more nice to Powell this time around than than the last regime, 2017, 18. But it's just there's no question that toward the end of the year, I think we're going to have much more tax cuts, stimulus, rate cuts, and maybe it's a little early on silver, but in that environment, silver is going to dramatically outperform gold, and that's what we saw in 2020. Like every bull market, the silver miners are up dramatically more than the gold miners, and silver is up dramatically more than gold.
You touched on the U.S. dollar, and the U.S. dollar, if we look at it versus, let's look at the DXY or the Dixie, it got as high as 110 in January. Now it's around 105. I think you mentioned a couple of times you see the U.S. dollar going a lot lower.
Oh yeah, this is the big kahuna, because you've got the twin deficits, which have always been there, but the dollar was saved by rate hikes. The Fed hiked rates violently, but when they did that, interest now is because of all that front end of the yield curve, all those T-bills with those 5% yields, your interest costs are $1 trillion. So now you have a slowdown, you have higher interest costs, and you've got China stimulating, and Europe on the fiscal side, fiscal expansion over there. And that's a recipe for a really weak dollar. And so and Trump, when if you talk to people in the Trump team, they really want a structurally weaker dollar, because our manufacturing base in the United States, we've taken 5 million jobs out of the United States. We've shotgunned them around the world. We've decimated one of the lines in my book is, if you actually go through the Appalachian states and the J.D. Vance territory of the United States and the Rust Belt, their life expectancy for 50-year-old men is falling at the fastest pace in 20 years, and it was before COVID and after COVID. It's structural. It's fathers that were had great jobs in the manufacturing sector that are now working at pizza parlors or in the restaurant business, and they have to work 3 jobs to support their kids, and it's just a real horror show for middle class families, and that's why Trump was elected, and those Rust Belt states put Trump in office.
And I'm sorry, when you said 5 million jobs have left the U.S. over what time period?
That's last like 30 years, where we globalized, we had incredibly powerful uh, trade trade lanes and trade systems around the United States, and we became a country that was completely dependent on global manufacturing. Now, both Republicans and Democrats want to reshore jobs. That's really inflationary, and so that gets you into that's another secular, kind of inflationary force that's going to be with us.
So, Larry, I want to summarize a lot of the points you made. So, you're looking for a big slowdown in the U.S. And I think you said it's going to head into a recession. We're going to see a big pullback in the S&P. Did you say down to 4,000 or 3,500?
I'm thinking of low fours. Yeah, 40, 41, 42.
Okay. And in this and you think a lot of that money in the U.S. is going to flow over to Europe. So sell the U.S., get long Europe. You also want to get long hard assets, precious metals, gold, silver, palladium, platinum, oil, nat gas.
And emerging markets like Brazil's got an election coming up next year, and if you get a market friendly candidate there with a commodity producing country, I mean that market could be up 50%.
And seeing how you're talking about emerging markets, what about Canada?
Canada. I mean, I wouldn't call Canada an emerging market, but oil producing country, and I think above all the Canadian natural gas names, Tourmaline. If Carney wins, it's not that bad for for natural gas in Canada. But if you really have a market friendly solution in Canada, then your natural gas names are going to be up a lot.
No, I refer to it as an emerging market because in the last 10 years, which corresponds to the amount of time the Liberal government's been in office, our economy has not grown. I think it's grown about 1%. Okay.
Oh God.
So it's things have not been too good in Canada. All right. So I want to talk about your book, How to Listen When Markets Speak. You brought it up a few times, but there's a lot of interesting insights in here from many interesting people. Maybe you can just touch on that.
Yeah. So we sat down with, what I've tried to do is democratize information. And in the chat, we work with, I'd say 80% of our revenues are hedge funds, mutual funds, and pension funds. And the other 20% are large families and wealth managers. And what I've noticed over the years, because I started off on the retail side of the business, it's just disgusting the way, kind of the big banks would take the best ideas, the best research, give it out to the institutions, and eventually it makes its way toward retail. And so I think that's a game that's gone on for a long time. And so we created our Bloomberg chat, our bear traps report to try to democratize information and level that playing field. And in the book, we sat down with David Tepper, Charlie Munger, David Einhorn, some really incredible investors. And the whole goal of the book was kind of like to bring, that investor behind the scenes as to what, how the institutional investors look at the world, how they look at risk, how they look at reward. And so, I appreciate you having us on.
And do you have any plans on coming to Toronto in the near future?
Yeah, we did. Mackenzie Investments invited us up there last summer for, the old secret is because the publishing houses, you make about 10 times more on the speaking tour than you do writing the book. And so we've been getting a lot of different speaking engagements around the world. So I look forward to coming back, hopefully in the fall.
Yeah, I would love to spend some time with you. Well, listen, that was a great discussion, Larry, and I want to thank you very much for spending time with us. If somebody would like to learn more about your book, and you've written other books, or follow you online, where can they go?
Well, I think, at ConvertBond on Twitter, X, and then I guess info at thebeartrapsreport.com, info at thebeartrapsreport.com. Reach out to us. We'll get you on either in our Discord room, or we'll get you on the Turning Point, our weekly publication, and we'll kind of walk through and democratize information together. We want to give investors a lens on a buy-side conversation.
Larry, once again, thank you.
Thanks, James. Appreciate it.
Jonathan, thank you very much for joining us. How are things in Toronto?
Well, not too bad. We're looking forward to better weather and hopefully a new prime minister at the end of the month. We'll see.
Yes, it's interesting times. So you just sat in and listened to my discussion with Larry McDonald, and I'm curious to what your views were. And just to summarize for our viewers, he's very negative on the U.S. economy. He's looking for not only a contraction but a recession in the U.S. Big pullback in the S&P. I believe he said down to the 4,000 level. He is suggesting investors get long a lot of hard assets or real assets, gold, silver, oil, nat gas, uranium, palladium, platinum. What are your views on that?
Yeah, there's much that I found very interesting listening to Larry. He's excellent in terms of his analysis, especially in the macro economic areas. And certainly the area that he really zeroed in on was the debt levels. And he talked a little bit about that in terms of the US, $1 trillion now, their interest cost on a $5 trillion revenue. So you're talking 20% of their revenue now is going towards interest costs, which again is not sustainable. And I think the other point that he made along with the debt issue was there's going to be 15, 16, 17 trillion that has to be rolled over in the next 12, 16 months or so, which is just a massive amount of debt. So what are they going to do with that? So I think, yeah, clearly the pressure to try to get interest rates down is a big issue. And with all of the uncertainty and so on, I think that, again, lower economic growth, we're seeing some earnings, in companies coming back. And I think his point that, the S&P 500 earnings are probably overstated somewhat, and we could see those come off, and then that would also take the market down. That would the benefit there would be yields coming off, and so we see some of that also in terms of we're looking at the the stock market and where we're investing. We're trying to again take advantage of that, and if that does parlay into a lower U.S. dollar, then yeah, the hard assets is going to be the place you want to be. We are in some of those hard assets that he talked about. So yeah, so I agree with quite a bit of his analysis. I think it's excellent. I'm not so sure, European trade. I guess I look over at Europe and I realize there are some very undervalued companies. And I think that's what he was pointing out. Go to Europe, find companies that are undervalued that you can play in the hard asset sector. I think that's great. Just to go to Europe and buy the indexes, I'm not as convinced of that. But I know what he's saying is, there's some good values over there. And if you go picking and you're selective, I think you can find some great opportunities and better valuations than probably there are right now in North America.
Yes, I know. I understand what you're saying about Europe because I've never heard anything good about Europe from an economic point of view. With regard to Germany, everything I hear is how bad the economy is, but yet here the DAX is at 15% on the year. It's trading at or near all-time highs. The FTSE is doing the same sort of thing. So I'm really surprised to see all this money flow into Europe, given how bad things are economically.
Yeah, and I think that's, as you know, being in the capital markets as long as you have, as well as myself, that sometimes the stock market will outperform the economies themselves, right? And that's sort of the ironic thing. And so even though the economy might not be doing that well, if you can find great companies that are trading at low valuations that have been beaten down, sometimes you can perform quite well. And I think that's really what he was talking about also, because he was very much talking about certain sectors and businesses that like BHP and so forth that are trading at fairly low valuations. Yeah.
And you mentioned the fact that the U.S. has all this debt. And once again, just to recap for people who didn't see the first part of this interview, but the U.S. has $37 trillion in debt. When Trump first came into power in 2016 or during his first term, it was around 18 trillion. So there's been a massive shift or massive growth in the level of debt at the federal level. And one of the big issues that the federal government is facing now is they got to refinance this debt. Their interest expenses are well over $1 trillion. It's only going to explode. So what they're trying to do now is bring this economy to a screeching halt, slow it down so they can slow inflation down also and bring interest rates down in the process. And then therefore, when they go to refinance, they're going to be able to do it at lower rates.
Yeah, term out the debt so they can actually extend the debt out into longer periods of time, 5, 10 years, which they should have been doing when they had these record low rates. So again, you just look at just gross incompetence in some of the governments. I mean, similar to what we see up here in Canada, but the Treasury decisions that were made under the Biden regime there were just very, very poor decisions.
Now, even though you are based in Toronto, you invest a lot of money in the U.S. Maybe you can just give us an overview of how you and your team are investing money right now for your investors and what % of cash are you currently holding?
Sure. I mean, because we're next to the U.S. and it's the most, the largest, most dynamic economy in the world, definitely the majority of our money is going down into U.S.-based businesses, and we have a couple of companies that are based in Europe also, but again, largely global businesses. What we're doing is we're more value investors, and so we buy individual stocks, and so we're actually trying to look at certain sectors that we think are advantaged, trading at reasonable valuations, and not in the stratosphere. So we're looking at areas. If we're looking, say, for example, in manufacturing and industrial, we'll be looking at companies like Schneider Electric, which provides parts and equipment and for data centers, for building up of the electrical utility grid and so forth. We have some exposure to some oil and gas, and Larry was talking about that. He's quite right. The free cash flow yields on some of the energy companies are really high. We don't have a lot in the energy, but we do have some in there because it is fairly cheap. And again, if you get into inflation, stagflation, you can do quite well in that sector. We have some in technology. Again, I don't think that technology trade is dead. I think you need to be very selective on the companies that you're purchasing, companies at reasonable valuations. And in fact, what we're trying to do is if the NASDAQ really were to come off, what kind of companies would we like to buy? We have a buy list that, if we get another 20, 25% off some of these companies, we'd actually pick them up. So again, technology is not going to disappear. And we also own some of the gold and silver exposure, which Larry talked about also. And we've been there now for a number of years, again, because of the monetary situation, because of the different governments around the world shedding some of their treasuries and central banks buying the gold. But we typically are going to buy some of the royalty companies, which have done quite well here: Franco-Nevada, Wheaton Precious Metals, Royal Gold, Sandstorm, etc., Cisco Royalties, and we have some of the miners. And he made a number of times he pointed out that the miners are cheap, and they definitely are. But I do think you have to be incredibly selective on which miners you are buying. And so I think as investors, as you look at this space like gold miners, you've got to go at companies that have a history of capital allocation, discipline. It might be the place for some investors just to pick up an ETF where you're going to get a number of miners. It's hard to pick individual miners unless you're really following great analysts and people that are selecting them, because they're so volatile, and you've got political risk and all sorts of different risks that can come up with individual mines. We own Agnico. Sean Boyd's an amazing executive, and they've run that company well. Pan America Silver we own, Mag Silver. So we do have a couple of miners, but not a large portion of our book. We've stuck more to the royalty companies because they're a little safer, more diversified, cash flow oriented, and give us good upside. And I think people should also know that the royalty companies, if you take Wheaton or a Cisco, just as a couple of examples, their organic growth, in other words, they're just the growth on new royalty streams coming on and growing the miners that they're getting the royalties from are also growing. They've got 8 to 10% organic growth, and that's without any change in the underlying commodity prices. So there's growth in these companies. They're actually expanding. If you get growth in the commodity, of course, my goodness, you can get a real lift. So so that's the way we approach it.
You didn't tell me your cash position.
Oh, yeah. No, we're sitting around 27% cash. And we do that because the market, as Larry pointed out in his presentation, it's not cheap. I mean, I think people have to get their minds around it. It's not cheap, particularly if we're going into a slower economy and tariffs and all of the uncertainty. Warren Buffett, I think, is a good barometer too. Carry around a little more cash. Yeah, you're only going to make 2, 3, 4% on that money, but it's not going to go down, and it gives you firepower. And that it hasn't hurt our performance that much, really, in terms of carrying the extra cash, because we're stock pickers and we've picked some good businesses that have done well. But if the market drops, you can pounce. And we've got companies that we want to buy, and so it gives you a real leg up. And I think that's always important for investors. Have a little bit of powder dry, hold some money back, and then buy big time if you get a real drop in one of your favorite companies or in the market in general.
So you do have concerns about the U.S. economy and the U.S. stock market. Are you expecting a significant pullback this year, like similar to Larry's?
Yeah, I mean, I understand Larry's argument, and I think that's quite possible that it could slip. I'm a little bit our own position at Rocklink is I'm a little more optimistic in terms of the U.S. economy. Now, in the short run, look, we got the tariffs. They're dealing with the Biden spending craze at the end of his term, and they've got to rein in that deficit. So, and Doge is cutting jobs and so forth. So there's a number of things that I think will pull back some of the growth in the U.S. That's not a bad thing, though, if it's reallocating the economy back into more of the private sector and shrinking some of the public sector and not wasting the money. I mean, you've seen some of the waste that's going on. So that's not a bad thing, but I think it can lead to slower growth. But lower regulations, lower taxes, bringing more capital into your country, reshoring some of that. Yeah, it might be a little bit more inflationary, but you're going to drive a much stronger economy. And I think that the policies of Donald Trump, his economic policies, are very, very sound. So I actually like what he's doing. It's not going to be easy, though. And look, there's going to be some hiccups and there's going to be some challenges. And I think the way he's handled tariffs has not been optimal. I understand what he's trying to do, but as being in Canada and a recipient of some of his bombastic comments, it's not, I think, the best way to go about the tariff analysis. But that's Donald Trump. That's the art of the deal. I think that's what we're in for, and the world just has to adjust to it, and we invest around it basically.
So we started this conversation with you mentioning that there's a federal election going on in Canada. Any thoughts?
Well, I'm praying. I'm a man of faith, and I'm praying aggressively that the Liberal government does not get re-elected, and the NDP party is also as far away as possible. So you can tell that I'm much more favorably inclined to the Conservative government. They're not perfect, but they have an agenda which is, I think, much more Canada first centric. Pierre Poilievre is articulating a much more rational program, and we cannot continue to do the things that we've done the last 9 to 10 years. And there's no question that Mark Carney, the current prime minister, is inextricably linked to those policies. That is his ideology. And to think he's going to change the course from what Trudeau is doing, I think, is incredibly naive. And so I think it's very important that Canadians elect a different government, a government with a vision, a government that wants to bring capital back in the country, shrink taxes, shrink regulations, and also the size of government. That's the only way forward if we're going to turn this thing around and take advantage of the incredible wealth we have in this country.
Yes. You and I share a lot of the similar viewpoints, but it is shocking that this government's been in power for 10 years and our economy has grown by just over 1%. It's truly astounding.
Yeah, it is astounding given the tremendous wealth in this country. I mean, we're one of the wealthiest countries in the world when you look at the natural resources and the endowments that we have in this country. I think Canada's a great country. We have an amazing history. We've got wonderful people and great assets. We just need incredibly better leadership.
Jonathan, I want to thank you very much for spending time with us today and sharing your thoughts on what Larry had to say about the U.S. economy and Europe. And if somebody would like to learn more about you and your firm, where can they go?
Yeah, just rocklink.com, rocklink with a C, so ROCKLINC, not with a K there, rocklink.com. Just go to our website and send us an email there, info@rocklink.com, and all of the information basically on our website there. And we'd love to talk to you. And we have a lot of clients that have come through and through Wealthion. They've contacted us. We've sit down with them. It's free in terms of sitting down and getting an analysis and just hear us out and develop a long-term financial plan. And we'd love to do that.
Jonathan, once again, thank you.
Thank you very much, then, James.